So today's discussion is about something which we have all known has been a problem for about 2.5 years now, and many people knew it was a problem for about 4.5 years now, and that is what to do about the secondary mortgage market. And the answers so far have been, I think, rather dispiriting and have been rather difficult to interpret. We've put together a panel of three disparate viewpoints here. One, an academic viewpoint. One, a private commercial mortgage viewpoint. And the third, a government regulation viewpoint, in particular Fannie Mae and Freddie Mac and the Federal Home Loan Bank of San Francisco. Let me turn the meeting over to Larry, who will introduce the speakers. And as I say, we will have an informal conversation followed by plenty of time for questions and answers and fights. Larry?
Well, thanks, John, and welcome, everyone. Really glad you could all join us. I think the puzzle regarding what to do with the insolvent government-sponsored enterprises, or GSEs, in the mortgage market is critically important in at least four key respects. First, stabilization. We want to regain market stability and address the foreclosure backlog. Safety, preventing a repeat of the crisis that we are only now beginning to emerge from at any time in the future. So stabilization, safety. Equity, ensuring that the systemic risk moving forward does not overly burden the least advantaged households. And lastly, our ongoing concern about access, ensuring that the government role in these complex markets, whatever that role may be, furthers the broadest sense of the public interest, including crucial elements of affordability and neighborhood improvement. As you can see from the biographies of our speakers, which are on the back of your program that you found on your seats today, we've assembled an excellent panel for you. The format will be that first Professor Jaffee, who's a scholar of deep and lengthy research experience concerning Fannie, Freddie, and the mortgage markets, will present his perspective on where we're at, where we need to go. Dwight, thanks so much for being here with us. Then Larry Parks, in his remarks, will provide us a sense of the Federal Home Loan Bank System's view on the GSE policy moving forward and the current kind of temperature in Washington, in Congress and the regulatory agencies on these questions. Larry, thank you so much for being here. And finally, Chris George will respond to Dwight and Larry's remarks, treating us to a sense of the practical, competitive, still recovering market realities currently facing the industry. So Chris, we're so glad you could join us as well. Before we get underway, I'd be remiss if I didn't thank Brian Gothberg, our very capable program coordinator, for putting together all the logistics today. So thank you, Brian. And with that, Dwight, would you be so kind to get us started?
Great. So I'm really pleased to have this opportunity, and I, in particular, to look forward to interacting with the panel. I think it could be a very interesting and useful discussion. Fixing mortgage finance is obviously a major issue of the day. I'm going to give you sort of my views pretty straight out. We have limited time here, and so rather than giving you a lot of footnote caveats, I'm going to tell you what I really think pretty directly. I should have a caveat, though, which is a fair amount of my research on the topic is done jointly with John Quigley, and you can read our papers, but he's not responsible necessarily for what I'm about to say. Maybe not be a problem. I don't mean to make it sound too terrible. Where I want to start is the big picture question here is, what is the proper role for the U.S. government to intervene in the U.S. mortgage market? And I would say the recent experience has not been very encouraging. I would say that the regulator of the GSEs failed, and we now have two very big entities, Fannie and Freddie, that are going on $300 billion in the red, and there was supposed to be a regulator who was responsible for their safety and soundness. We've also had even bigger losses for a large part of the U.S. banking system, and we had a group of regulators who were supposed to be dealing with that. And so there is not a wonderful track record of government intervention, certainly in a regulatory sense, in the U.S. Mortgage markets. those aren't even the extreme case, and so more extreme statements would be coming from people like Peter Wallison at the American Enterprise Institute, who would be blaming the Community Reinvestment Act and the Fannie and Freddie housing goals as a primary source of the breakdown. I would also say that the GSEs, I've been arguing for decades, really, that the GSE structure of a private-public partnership was really doomed to fail one way or another, and in some ways, I'm only surprised it took so long. So there's a lot of negatives about what the government has not done very well in intervening in the mortgage market. But nevertheless, as we sit here today, clearly there are cries in at least 3 different areas for the government to intervene very actively now. And the first is, of course, mortgage modifications. The second is to deal with predatory lending. And then the third is a longer term, how should we reform this mortgage market once the current problems are resolved. So I'm going to try to talk quickly about each of those. On the residential mortgage modifications, the main point I want to make is the economic fundamentals are much more difficult than I think the common perception is. That is, people tend to think that the only reason a large number of modifications are not occurring is because either the banks are completely dysfunctional or at worst they're actually acting in a very perverse, socially irresponsible way. And while there may be something to both of those, and I do think there is something to it, I want to suggest a large part of the problem is it's really a difficult thing to do to modify a residential mortgage under these conditions. And to give you a counterexample, let me give you an area where it's the same banks actually do it very effectively, and this is in commercial mortgages. If they have a mortgage to a big office building and the owner comes in and says, I can't continue to make mortgage payments because my building is half filled and all you have a claim on are my rental income, there's no recourse, so here's what I have, take it or leave it, very often the bank will say, yes, we'll modify the loan. Why so? Well, first of all, those facts are totally verifiable. They know exactly what that owner has available and they know they won't get a penny more. And secondly, they're not worried about the building down the street, the owner down the street coming in and who has a full building coming in and saying, well, me too, I can stop making my payments too and then you'll modify me. The answer is no, we have a legal claim on your rental income and you're full up and so there's no way we modify you. So that really works well. In fact, right now as we sit in the commercial markets, there's even a concern that the banks are being too lenient on modifications. The theme in some of those markets is that banks are extending, which means modifying, and pretending that this is all going to work out okay in commercial lending. So where there's an economic incentive, they clearly do it. But when now you turn to residential mortgages, the situation is completely the opposite. There is no way for the bank to confirm what are the cash flow budgetary decisions being made by the household, either in the past, did they take vacations and say, you know, we just don't worry about paying our mortgage, or were they very conservative and saved up so they can? What's happening right now? Do they have a voluntary decision? It seems we have a fair number of homeowners who are actually paying their mortgages, even though they're underwater, so their house is worth less than their mortgage, but something like 70 or 80% of those borrowers are still making their payments, so that's a voluntary positive act. And then thirdly, you've got the future is what happens if I modify this loan? Is this borrower simply going to default in the future? And there is a very high relapse rate. So the bank looking at this uncertainty is very concerned. I know for sure the dominant concern of the bankers in this world is if I modify a loan for somebody that is delinquent, this whole very large tier, the majority of the borrowers who are current are going to say, well, wait a minute, if I just become delinquent, then I get my loan modified. Why shouldn't I do that behavior? And the banks, and this has been true for decades, banks are very reluctant to do a loan modification if they think it's only going to make the situation worse from their perspective. That is, a lot of current borrowers become delinquent. So that's the main theme. There is a very important secondary theme in the subprime mortgages, which is most of these mortgages have second liens as well. So far, we're only talking about the first mortgage holder. When you modify a loan and make the borrower more able to make their payments on the first mortgage, you're also making them more able to make their payments on the second mortgage. And this is a benefit that goes to somebody outside of the bank. In other words, by the bank taking its hit, it's making some other investor out there who holds a whole portfolio of of second liens much better off, so the bank doesn't get all the benefits of it. In fact, they're widely dispersed. So the punchline here is in my opinion, there's probably a will on the basis of the banks, but I just don't think that there's any way for them to really deal effectively in a profit-making or profit-neutral way on these loan modifications. And I think the proof is in the pudding that these government programs, such as HAMP, which have provided fairly significant subsidies to the banks, have basically gone nowhere. As just to give you one set of numbers, I think the HAMP program was budgeted at $75 billion, and to date they've spent $5 billion of it. So here's $70 billion of money available as subsidies to the banks, and they're simply not availing themselves to it. And I think it's mostly the economic fundamentals. Now, that's all so far I'm talking about private banks. If we turn to the GSEs and the FHA, it's a slightly different situation because these are, in the case of FHA, a fully government agency, and in the case of the GSE, in a very complex situation. Not only are they a government-sponsored enterprise, but they're now under a conservatorship, which is actually a very delicate situation for the conservator because technically his responsibility is to bring them back to financial health, although I would say that the administration has to some degree been using them as a policy instrument, just as they are the FHA. But what do we say about these programs and these two institutions? Well, the first is there is one big difference. Both the FHA and the GSEs have been very responsive on refinances. And if you're looking for where there is a win-win in this area, it's the refinancing. The reason the FHA and GSEs are very positive here is they're already on the hook for the credit risk. So if they've got a borrower, whether it is delinquent or not, for them to refi the loan and thereby make the payments more acceptable to the borrower is only a benefit to those entities. Now, there's going to be another set of investors who are holding these mortgages who are now going to find out that instead of getting 6% interest, they're only getting 4% interest. So somebody does take the hit, but it's really, generally speaking, neither the FHA, who holds no mortgages, nor the GSE, for whom most of their mortgages are not held by third-party investors. So refis, I think, are the win-win. But now, if you turn to loan modifications, more or less everything I just said about the private institutions basically apply to the GSEs and the FHA as well. That if they're looking at these things in terms of real economics and is there a benefit, is the subsidy that's being provided under HAMP sufficient to make us do this, the true answer in many, many cases is probably not. There is one issue that's really been on the front burner, and maybe I can give a little clarity on this, which is the GSEs and Mr. DeMarco, who's the head of the FHFA, the GSE regulator, who I actually have known for many years. I would say he's a very smart, very dedicated public employee. He is a bureaucrat, and so there's what I'm about to say shows a little bit of bureaucratic, but I think he has goodwill. And the issue is Fannie Mae and Freddie Mac have so far been willing to modify loans to change the interest rates and have been willing to give out forbearance on principal, but not forgiveness. And let me tell you the difference. It's quite interesting. And there's a big difference. Forbearance, and this tells you how much they are doing. So forbearance, and I think any qualifying borrower, Fannie and Freddie, would do this forbearance. They said, we will write down your mortgage to the current value of your house, and we will readjust your payments accordingly so that we have now modified your loan as if you bought the house today and took out a 100% mortgage. And you used to be 150% or something. We've really given you a huge benefit. And you'll make payments, as long as you live in the house, you make payments based on that new mortgage. The only but is when you go to sell it, if you sell it for more than the written down mortgage balance, in other words, we, Fannie or Freddie, get all the proceeds of the sale up to your original balance. If it was a full forgiveness program, the homeowner would get to keep any of the capital gains that might come in the future, whereas under the forbearance program, Fannie and Freddie get to keep those. My opinion is that's still a pretty good deal for the homeowner. As long as the homeowner stays in the home, there's no difference between the two. Now, admittedly, if you thought there was going to be a huge capital gain at the far end, you obviously you would prefer to have a forgiveness. But I think in terms of keeping people current and solving the immediate problem, and if you're thinking of payment is the issue, and all the research shows it's the payment that is the issue, the forbearance does just as well. DeMarco would also point out that the difference between them from a technical standpoint is enormous, because a forgiveness needs a new mortgage. And so you now have to go through a huge amount of paperwork. Fannie and Freddie have 1,000 servicers out there, each of whom has to be given directions exactly how to do this. And every time there's a new wrinkle, it's a huge manpower problem for them, whereas the forbearance is like 2 lines in a directive. So I think there's a lot of reasons why Fannie and Freddie are very happy doing forbearance, but I think there's a good reason why they're not quite willing to do forgiveness. But that is an issue, and others may have another opinion. Now, so far I may sound like I'm helping the banks here a little bit, so I want to be quick and explain 2 issues in which I really feel the banking system and the whole mortgage market, brokers and everybody up the line really failed the U.S. Homeowners. And the first is predatory lending, and there is just no doubt that significant amounts of predatory lending occurred. I think anybody who did it should be punished under the full law. And the good news here is I do think that sitting here today, it'll never happen again in the United States for 2 reasons. First, in July of 2008, the Federal Reserve published new truth in lending laws that basically say predatory loans can never be made. And John and I have written about, I think, the most interesting part of those rules. There's lots of technical stuff which is all good. You can't do liar's loans, and you've got to do this, and you've got to do that. But the real punchline, and I think the solution here, is it says from now on, the law of the land is on a mortgage loan, it's the lender's responsibility to determine that the loan is suitable for the borrower. It's a suitability requirement. And I think, in effect, that's what you really want. You want the lenders to be responsible that when they make a loan, it's a sensible loan for the borrower. And that is now the law of the land. Interestingly, it's been the law of the land all over Europe for decades. So we've only come upon it, but it gives me a lot of confidence. In addition, of course, we now have the new Consumer Financial Protection Bureau, and I think they're going to probably go even a little bit further. But I think one can now be reasonably happy about that. The second area of judicial issues are the what I would call predatory foreclosures. These are the robo-signings and all of the stuff that the banks did as a shortcut to avoid the details, the technical requirements of the foreclosure laws. And I think it's abominable that they did this, and I think this Attorney General settlement is at least the right idea for making them pay for their sins. I think what happened inside the banks is that, or to give you a little background, the judicial foreclosure rules that we have, and they're state rules, so they vary by state, but they all have the same basis, which is 100 years or more. Banks were also doing terrible things in foreclosing mortgages, probably even worse things than they're doing today. And every state made laws that said we're going to protect the homeowner and require some sort of a judicial process and a judicial review and signature requirements if you're going to foreclose in someone's home. And that's the law of the land in each state, although they vary. And I think the banks, looking at this just in the last 5 years, said, well, those are old, archaic rules. They get in our way. No one thought about robo-signers. What's wrong with that? And I think the banks should be punished for that the spirit of the law, the letter of the law had to be obeyed. And I think the spirit of the law was equally well. So to be clear, in these areas, I am very law and order and think the banks really were terrible. Another issue that you'll hear a lot about, and I won't spend a lot of my time here because I want to get on to other things, but just mention, is securitization. It's very common in Washington to blame a lot of the crisis on securitization. And I have a quote here from Sheila Bair, who was the regulator head of the FDIC during this time, saying, in effect, it wasn't us, the regulators, that goofed. It was securitization. It was this mechanism. And I think that's really unfair and completely wrong and could have perverse policy ramifications as well. What's wrong with it is securitization is a method that's existed for 30 years or more. This is the only episode in which we've ever had any claims that it had perverse consequences. I would also remind you that 80% of all the securitized mortgages over the last 10 years were prime mortgages. So it's not as if securitization was a channel that said, show me your bad loans and we'll securitize them, but you keep the good ones. That isn't at all what was happening. Everything was being securitized, in effect, good, bad, and indifferent. And I think in the end it failed not because of the system, but because the investors at the far end, who were the most sophisticated in the world, simply weren't looking very carefully, or they actually thought things were going to be fine. So blaming it on securitization, I think, is actually misguided and has very perverse policy consequences, because it's ended up in this Dodd-Frank 5% risk retention rule, which in my opinion is actually telling the banks, please keep the bad stuff in your portfolio. And the major cost of this crisis is actually not the mortgage defaults, it's the banking default, it's the banking crisis. And this is in a way saying we want more of that, and it's very perverse. You can see it as they try to write the regulations that they're grappling with it. So a lot of the issue right now is to have an exemption from the 5%, you need to have a qualified mortgage or a qualified residential mortgage, QM or QRM. And already you see the battle. On the one hand, some folks are saying, well, if we're going to exempt a mortgage, it should be really good. And it's only the bad ones that should have this requirement. And then a lot of the mortgage lenders come in and say, no, 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 you want to allow everything to be exempt. And so, but it's the wrong criterion. You want the private market to have to take the risks and make the decisions on its own feet. You don't want some bureaucratic rules which will end up having perverse consequences to be its. But and I can talk more if you ask. Let me give you a few numbers about what's actually happening here, and I'm about to turn to the future. One theme you hear a lot about is the comment, well, the private market is dead, so whatever we're going to do from here on out, it's got to be the government because there is no private market. And I think that's untrue, and what it misses is the extreme degree to which right now the private market is being crowded out by the government agencies, exactly the GSEs and the FHA. And you can see it on that graph over there, that somewhere around 2007, the private market activity peaked, and then it plummets at the very same time that the GSEs and the FHA are doing just the opposite. So there's clearly been, in terms of market share, almost an exact substitution. Now, a correlation doesn't tell you the causation, and obviously it could go either way. It could be that the crowding out is the government went first and then the private market disappeared, but you could equally well argue the private market disappeared and we needed the government. All I'm going to suggest is the fact that you don't see very much private market activity today doesn't tell you necessarily that the private market is dead. And secondly, if you look into a little more detail here, this shows you the share of each of these three categories, the FHA, the GSEs, and then the private market, in which I've had to include the VA because I couldn't separate them. This tells you for each of these lending groups the share of the mortgages that they made that were home purchase rather than refinance. And what you can see is that for the GSEs, almost 80% of their activity in the last, over the last 3 years has been refinancing. So the GSEs are not guaranteeing new mortgages. They're doing refis, which makes good sense, but it also tells you they're not quite as noble as you might have thought. The noble entity is actually the FHA, for whom 70% of their activity is home purchase loans. But the private market is not doing so bad. About half of what's going on in the private market are home purchase loans. So if you focus on ongoing business, real business, where someone's buying a house and it's a real mortgage going to the future, the private market isn't quite as dead as the sort of standard quips have it. So let me turn to the future here. Actually, I think I skipped what? Oh, slide's missing. Where we stand today is in the step of where do we go in the future. And the missing slide was supposed to be from the Treasury issued a white paper in February of 2008, a little bit more than a year ago, February of 2011, a little more than a year ago, in which they basically said there's three proposals, three paths we could take for reforming the U.S. mortgage market once the crisis is done. All of their plans propose to close down the GSEs. I would say today there's very few folks that are willing to stand up and say we should keep the GSEs or recreate the GSEs much as they were. Maybe someone's going to disagree here, but at least most of the folks that I talk to, certainly in the academic world, think that the GSEs are goners, and the question is, how do you replace them? And basically what the Treasury white paper said is there's two extremes. One is you just go private markets, and we admit that the government's government's interventions were not very functional. And the second is, no, we desperately need more government, and we're going to do it by having what are basically guarantee programs in which the government will guarantee mortgages, just as the FHA has always done for lower income borrowers, but basically in one way or another expand the government's guarantee through all conforming mortgages, which would take you up to 50 or 60 or 70% of all U.S. Those are the extremes, and there can be delicate distinctions between them. There's two questions that come up in comparing them. The first is, will the private markets work? Is that actually a feasible plan in any sense? And then the second is, what do we think of a government insurance program? A lot of my recent research has focused on the first question of will a private market work, and my conclusion is a very affirmative yes. And there's really two sets of evidence. The first is, one should not forget that you don't have to go back more than 20 years in U.S. history to realize that most of our mortgage markets have always been private. That 20 years ago, or certainly 30 years ago, the GSEs were very minor players in these markets. The markets basically operated by having local banks make mortgages to local homeowners and keep those mortgages for the life of it. And there was no particular government intervention, and that's how 70 or 80% of the U.S. Market worked. And it actually worked, I think, in terms of a mortgage market, it worked well. Where it ran into problems was that the banks themselves got into trouble, and so to have a bank-centric mortgage system led to instability in flows into the mortgage market because the banks were unstable, and that's led to securitization and bigger roles for the GSEs trying to link it to the capital markets. But the fundamentals, did the mortgage market work under that old system? I'd say it actually worked quite well here. Or if you want a more current example, there's a very nice data set of how the housing and mortgage markets work in the 15 largest Western European countries. And I've done this careful statistical analysis of this, and the fundamentals are the European markets have worked much better than ours over the last 20 years. Their house prices are much more stable. Their housing activity is much more stable. Their home ownership, the U.S. has the same home ownership rate as the average of these 15 European countries, and their mortgage rates are actually lower than ours. So it's really a pretty impressive commentary that, and they have no government intervention. Now you might be surprised to hear that Europe doesn't have much government intervention, but there's there's a couple tricks going on. One is, under the EU rules, if any country decided to subsidize mortgages and housing in its country, it would violate the EU rules. You're not allowed to do comparative beggar my nation subsidy programs. So it's just forbidden, so they can't do it, and they don't do it. The second trick is they do have recourse. And basically what that means is that any borrower in any of these European countries taking out a mortgage understands that they're going to pay that for the rest of their life if necessary. There is no bankruptcy exit, and there's no hand the keys to the owner. And it's had a very positive impact in these countries in the sense that at the beginning of the mortgage, the homeowner, the bank, and actually the government, who are fairly serious participants in the quality of these mortgages, everyone realizes it has to be a suitable mortgage. Otherwise, it's going to end up in chaos for all of us. And so it's led to a much better system, I think, in which everyone understood that you couldn't default, and therefore we have to make a loan in which you won't default and won't want to default. So that's the positive experience why I think a private market could work very well. On the negative side, the problem with expanding the government insurance programs is that the U.S. government, by and large, has a terrible track record as an insurance entity. And the worst example of it is the National Flood Insurance Program. If you read the law that created that program, it said all the right thing, that premiums were to be set actuarially fair, that the riskier the house, the higher the premium, because we want to discourage people from building houses on risky water floodplains, and all the right stuff is in the law, and none of it occurred in practice. What we've ended up with in the National Flood Insurance Program is highly subsidized insurance, encouraging people to put themselves at risk, and then with the most risky getting the biggest subsidy. And for years and years this worked out because the way they computed the premiums and the actuarial evaluations assumed there would never be a big one where a major city would get flooded. And once New Orleans got hit from Katrina, it turned out out the whole program was $20 or $30 billion in the hole, and they had to go hand in hand to the Treasury. So the reading of that is it actually had the worst allocational consequences of encouraging people to put themselves in harm's way, and eventually the subsidies, not only did they have a bad allocational effect, but it cost the taxpayers lots of money. And my fear is that as we expand the U.S. mortgage market to, say, do 70% of all mortgages be guaranteed, we'll see the same thing. I'm sure it'll start with the right words, and if you look at the current proposals, they all have the right words. They'll only be for very safe mortgages, and they'll be actuarially priced, and it'll all be fair. And you can just imagine what's going to happen to the first congressman who goes home and says, we just passed this nice bill that says if you can put 20% down and you have a 700 FICO score, the government will guarantee your mortgage. But if you're anything less than that, you've got to go fight out in the real world. Immediately the program is going to be downgraded, and you're going to start to say, no, we'll let 10% down loans in, we'll let 5% down loans. In fact, we'll subsidize those loans, and then you're just recreating the subprime mortgage crisis, in my view. So that is why I have this very positive proposal that we go to the private market. One final thought, and this is really getting much bigger picture. If you think about what's happening with all of the current crisis, it is that foreclosing on single-family homes is a terrible process. It is costly to everybody concerned. Our system just doesn't deal with it well, and I've tried to make the case that it's not simply perverse banks, but it's just a very, very difficult problem. And so you really want to come up with a reform in the mortgage market that eliminates that. And there is a cunning solution that a number of economists, and I'm now on the bandwagon, which would be to have a new mortgage contract that would have the feature that the balance that the borrower owes would adjust to changes in the house value. If the house, in particular, if the house value fell by 40%, the mortgage balance would automatically fall. You can think of it as an automatic forgiveness. And it would see built into the contract. Now, of course, the lender is going to say, well, that's negative for me. I get paid back less in those cases. But the lender should know he's already in that boat. In fact, that's what's happening to these lenders right now. And it's even worse. Not only are they suffering the loss on the mortgage, but they have all the deadweight costs of the foreclosure process. So I think it's a very interesting, intriguing idea. There are pitfalls. There are technical issues about how do you get the index right. So I'm not suggesting it's simple. But I do think it's the right way. And I would suggest this isn't the first time that we've had a major housing collapse in which the ultimate solution, not to have it next time, is the mortgage contract, because you may recall that in the Great Depression, the fault that was finally decided on after we went through blaming the bad banks and all kinds of things was that the mortgage contract, which at that time was a 1 or 3 year renewable mortgage, it wasn't the long-term fixed rate amortizing mortgage that was the fault. We fixed it, and it actually served us really well for 70 years, but it did have a flaw, which is if housing prices fall 40% and you've made a lot of loans to marginal borrowers, it has a problem. And so I'm going to suggest an ending. We might want to fix that once again. Thank you.
Well, thank you very much, Dwight, for setting the stage for us. Provocative ideas. We now have Larry Parks, if I can get his slides ready.
Okay, what do I hit to change the slide?
Well, I think you can use this, or you can use
Okay,
the
good.
keyboard.
Okay.
I think this should work. Hold on.
Yep. Okay.
Forward, backward.
Good morning. I guess I bring the contra view here a little bit, so I guess they want a little spice going on. I work for the Home Loan Bank of San Francisco. I do the legislative and regulatory work for the bank. But the views I'm going to give to you today are a mixture of my private views and also the information I have from what I do in my day job. So don't attribute all of them to the Home Loan Bank of San Francisco. Okay, so you can get me off the record. The Home Loan Bank of San Francisco is one of the 12 regional home loan banks. We're headquartered right across the bay here in San Francisco, and we're one of the largest of the home loan banks. There are 12 in the home loan bank system. Each home loan bank is separately owned by banks, savings and loans, credit unions, insurance companies, and community development financial institutions at this point. So primarily we're owned by depositories that exist in or headquartered in California, Nevada, and Arizona. We provide low-cost advances, which are basically loans, primarily for mortgages. From smaller institutions, we can engage in this business with small business loans and economic development lending as well. And in one of the crises that I'm going to talk about, in '89, Congress mandated that we create an affordable housing program. of which 10% of our income is awarded for low-income housing projects. This gap financing is worked with lenders and with nonprofit organizations, and it makes us the largest source of private capital in affordable housing in the country. As of December 31, 2011, the Home Loan Bank of San Francisco had $113 billion in assets and $68 billion in advances. Commercial banks are the largest share of us, which was a change that came about in 1989. I'm going to go through that a little bit. Then credit unions, savings institutions, and we have CDFIs as members as well. The home loan banks enable lenders of all sizes to hold mortgages on their books. Lenders that are members of the home loan bank pledge mortgages to the home loan bank is basically what happens. The bank in turn issues bonds through an office that we call that. I don't know why it says privately owned office, but it's the Office of Finance. And these bonds are believed to have an implied government guarantee. The cash from the bonds enable the home loan banks to provide advances on the loans, and we're cooperatively owned, and stock is not publicly traded, which is a big differential between us and Fannie Mae and Freddie Mac. The home loan banks were created as a source of liquidity for depository institutions and to facilitate mortgage lending through our advances through our member depository institutions. CDFIs are the one caveat in the whole notion of being a depository. We ensure that mortgages are available uniformly at low cost, and primarily our business has been on the non-conforming side. So if you think of the conforming market as being FHA and Fannie Mae's conforming loan limit, we tended to be on the other end. So we did both the low end and the high end and a lot of ARMs. As you know, 60% of mortgage lending is occurring through large institutions, and 40% of our advances are through these large institutions. And that large member access is a question about whether large members will continue to have an access to the home loan bank system because of Basel III and international accord. And that could have a consequence on the cost of our advance product. The home loan bank system is of importance because it provided a lot of liquidity in the last economic crisis. In 2008, when the markets fell, one of the reasons why you continued not to have a credit crunch in the mortgage system was one of the things we were able to do was expand in our advance product. And we went from a $640 billion set of 12 banks to over $1 trillion in a very short amount of time. And we've contracted a lot since then. But we provided stability and made sure that there was cash still available. I give you all that commercial so that you understand the cooperative structure and the other GSE, the one that's not in conservatorship at this point. And one of the things you want to understand is why that is. Historically, the government created Fannie Mae and Freddie Mac in the home loan bank system and FHA in the 30s. And we were created primarily to make sure that there was liquidity in the marketplace. We also had a secondary purpose, which was growing jobs and building the housing sector. Housing is 18% of the U.S. economy. So there was a reason why there was always a public purpose beyond just being a source of credit, which was to build an industry. The other thing is that from the 30s on, the government wanted GSEs to make mortgage credit widely available at low cost. This was really the first step into affordable housing. What the government did in the 30s was basically say we want a uniform system, move away from 5-year mortgages in a balloon, and create not only a 30-year mortgage, but make sure that credit is more widely available. A lot of what went on with the home loan bank system and Fannie Mae was really that most S&L credit was disproportionately in the Midwest and the Northeast corridor, and that the growth in the population even then was beginning to be in the West and the South. And one of the ways was to circulate capital so it could flow from where capital was locally controlled into a more national marketplace for growth. In the late 80s, in the early 90s, Congress made changes to ensure that GSEs actually reach communities largely redlined for mortgage credit. For the home loan banks, that was done in FIREA with the Affordable Housing Program, the publication of HMDA data, the publication of CRA data. And for Fannie Mae and Freddie Mac, it was done in FIDESIA, which is 1992, the infamous housing goals that Fannie and Freddie had. But that was really both were designed to deal with a past history of rampant mortgage discrimination. The GSEs had financial problems in the past. Legislative changes were made to encourage lending. And I wanted to give you a couple of examples. In the mid-'80s, it was Farmer Mac, which basically provides credit for the rural system. And in the late 80s, Congress believed that we, the home loan banks, were part of the problem in the mortgage credit crisis. The government's reaction was very different from what you've got going on now. In that case, the home loan banks, the government seized our retained earnings, which we had, forced the home loan banks to pay 20% of their income for Rep Corp bonds, which are bonds that were designed to pay for the crisis. and to clean up the S&L meltdown, created the affordable housing program that I tell you about, where 10% of our income was set aside for affordable housing, changed who our bank membership was. So at that point, we were owned by S&Ls, and said you're going to have commercial banks, you're going to have credit unions, the competitors to the S&Ls would be part of your membership. Took away our regulatory authority. At that time, we were both the regulator of the S&Ls and a source of credit. A little conflict of interest, huh? And so the government changed that, and then had the banks get in the business of providing low-cost mortgage credit. So kicked us back out and said, get your work done. In the current crisis, there's little talk about cleaning up the excesses of Fannie and Freddie, which most people believe are shareholder ownership. We're cooperatively owned, they're shareholder owned, and that pushed them towards pushing for more profit. Or portfolio growth. They were originally designed as securitizers. They grew a large portfolio to make income. Those tend to be the consensus views as to where the problem lies with Fannie and Freddie. And there's little talk about cleaning that up and retaining what has worked for the consumer. Let's be honest here. Standardization and securitization prices is what Fannie and Freddie brought to the table. Universal low-cost mortgage credit in the conforming market. Across the country, you can move, get a job, get a mortgage at about the same rate. Thanks to Fannie and Freddie being a big part of that. And housing as a counter-cyclical force that stimulates the economic recovery. Remember, housing has always served another purpose besides just being shelter. It's also been a place where we wanted to grow jobs. The natural tension among policymakers between risk and mission has radically changed in this crisis. We now are focused much more on the risk of the GSEs, the risk in the housing market, and much, much less on the mission. The current policy narrative, in my opinion, is that the administration in Washington and Congress are overweighting risk and underrating the mission of the GSEs. GSEs, under this scenario, caused the housing financial crisis, as was alluded to earlier. CRA and HMDA requirements cause lenders to engage in undue risk. That's part of the narrative that's being played out right now. The factors in this policy narrative, the continuation of the social good of housing, I think, is at play. And I think it's a much bigger question. Prior policy debates focused on what type of delivery agent we would have. Government, which was FHA, Ginnie Mae, public housing, Section 8. The private industry, which was PMI, which is private mortgage insurance, private label mortgage-backed securities, low-income housing tax credit, and foundation grants. And then a mixed sort of housing finance system, which was co-insurance that basically doesn't exist now in the multifamily arena, Fannie and Freddie, the home loan banks, the state housing finance agencies, public-private partnerships. These were all part of the way in which we sort of dealt with how we were going to deal with the social good. In the current narrative, we're debating whether it's sustainable to have the mortgage interest deduction continue, whether government should continue to guarantee in housing, whether we continue to have low down payments when you look at the QRM, and whether you have universal low-cost mortgage credit. That's the current debate, I think, that's going on. Now, just looking at it from a consumer perspective, under the current policy narrative that's being considered, could it mean higher rates, mortgage interest rates for mortgages? Absolutely. If you're talking about the private securitization being the primary thing you're worried about, raise Fannie and Freddie's guarantee fee. You keep raising it, that's going to be passed on to the consumer. Two-tiered lending system through covered bonds could be a possibility. You push covered bonds as an alternative to the home loan bank system and other things. You get a certain set of mortgages that are set aside by a certain set of lenders for a certain set of activities and treated differently from others. There'll be a price differential. Higher down payment requirements. You see the QRM. It's really talking about going to 20% and treating those loans differently. And does that raise everything up? FHA has raised up its down payments. We're starting to see down payment requirements continually to creep up. Higher costs for mortgages that are non-QRM but securitized. Again, these are just my thoughts. The question becomes, and some of this may be necessary, but you've got to be able to put that into the equation and not pretend like it doesn't exist on the consumer side, because I think that's the way the politics is going to work in this situation. Mortgage finance today, Fannie, Freddie, and FHA make up to 90% of the market today. Okay? So when we start having these theoretical conversations, we also need to deal with the reality of what's really going on. Home loan banks are the primary source of liquidity for lenders large and small in the height of the crisis. Data shows that 60% of mortgage lending is to large members and 40% of our advances are to large members. Dodd-Frank and the challenge of the piecemeal legislation that's going on right now, as we implement Dodd-Frank, we've got conflicts all around, right? On the one hand, we're encouraging depository institutions to be mortgage lenders. So we want to go back to a system where the lender is basically a depository, yet capital standards are being considered by Basel III implementers, which may raise capital requirements on depository mortgage lenders and discourage them from using the home loan banks as a source of liquidity. So if you raise the capital standards, you say they can't use us as a source of liquidity, you basically discourage them from engaging in mortgage lending. On the other hand, you're saying you want to encourage them to be the mortgage lenders. So this whipsawing of lenders in the future, who's going to be the delivery agent, is a tension in public policy and in the regulatory sphere. Bank examiners are rumored to be discouraging lenders from relying on the home loan banks to meet their liquidity needs, yet Dodd-Frank encourages lenders to keep whole loans. So the only way they can keep whole loans, one of the major ways they can keep whole loans is by pledging them to the home loan banks. On the other hand, examiners are telling lenders, I don't know if I'd let you rely upon home loan banks being around. I don't know if I'd let you rely upon that if that's a good thing or not. So lenders are getting whipsawed in the middle of this equation as to what they're supposed to do. So what's needed? I think we need an understanding and a direction grounded in fact. Raising interest rates and down payments to get the private label mortgage-backed security market or the covered bond market going is not a pro-consumer thing to do. And I think we need to deal with that as to, are we comfortable with the consumer, how the consumer will fare in that? Is the goal to increase private securitization even if it costs consumers more? I don't know. I don't know what the goal is. I don't know. But the nomenclature and the rhetoric seems to be, we've got to have private securitizing. And I'm like, okay. But are we concerned about this other issue or not? And I think that's where Congress is going to battle the administration. Home ownership is critical to wealth accumulation for lower, moderate, and middle income families. This has been a goal. And what differentiates America from Europe is that we believe in private ownership because we believe in wealth creation and wealth accumulation in the family structure and to pass it on. In the European model, a lot of your social needs are met through a governmental structure. Healthcare costs, your retirement system is much more guaranteed. So your need for the ability to accumulate personal wealth is very different, yet alone the ability to have intergenerational transfer. Is this still a public policy goal? I don't know. That's something that Congress and the administration will have to deal with. Comprehensive housing policy, including rental housing and home ownership, is a critical, critical thing. Okay, one of the reasons why we got into the conversation we're having now about subprime, we haven't had a rental housing policy in this country since the 70s. We've consistently cut away at 223 D1s, D3s, D4s, all the things that HUD used to do to encourage the development of apartment buildings went away. Co-insurance went away in the late 80s, early 90s, wasn't replaced. Section 8, we just basically didn't expand the program. Right? So a lot of the ways in which we grew apartment lending and rental housing, we stopped doing. State housing finance agencies tried to substitute some of it. They clearly didn't have the bandwidth that the federal government had. And the low-income housing tax credit has been a useful tool, but not a complete tool. Cross-subsidization is a critical feature for low-cost advances and GSEs in general. And I think policy has to decide, are we changing the cross-subsidization method by extensively targeting or limiting access on the size of institutions, and that this merits some caution. Because cross-subsidization is what Fannie and Freddie have been doing, right? By dealing with loans from all over the country. Cross-subsidization is what we do to make sure advances are low cost because large members borrow at a higher volume than smaller lenders, and both of them get a similar price point for the loans that they pledge to us. So that's been a key feature. And so when we go to limit large institutions from the Home Loan Bank, or when we go to limit Fannie and Freddie's national reach, or to target them or their replacement to be just low and moderate income, we don't allow that kind of cross-subsidization in the portfolio for risk purposes. So here's just some suggestions. Again, my opinion. One of the problems Fannie and Freddie had from 2004 on, from 2000 on, the Bush administration chose not to put public interest members on Fannie and Freddie's board. So the natural tension that exists in a GSE, which is between the public mission and private profit, usually is played out in the boardroom. That was not being played out in Fannie and Freddie's boardroom. They didn't have those guys there. They chose not to do that. Allow regulated depository institutions of all sizes to use the home loan banks, Fannie and Freddie, going forward. If you restrict us, which is very cute on the left and the right, which is to reduce you to small community bankers are the only people who should be members of the home loan bank system, and large institutions don't need you. Well, the cross-subsidization isn't going to be there. And what is the mortgage marketplace going to look like without that? Maintain the implied government guarantee so as to facilitate low-cost mortgage credit and not crowd out appropriated dollars for direct subsidies for affordable housing. When I look at the crowding out issue, I look at the appropriation process. There's a finite amount of money that the Congress appropriates in the HUD VA appropriations segment of the federal budget. Most of that money at this point is targeted towards lower income and community development money. Fannie and Freddie, or the substitute future, if they were on budget, or if we were on budget, would probably be allocating dollars of how much credit we could have within that same cluster. So there would be a choice that would constantly be being made. Are we going to help middle-class families be homeowners, or are we going to help low-income people get the subsidies that they need? There's a finite amount of government credit that would be available if the guarantee were on budget. Consider making Fannie and Freddie cooperatively owned versus public shareholder entities. Just a thought. If the problem was that their structure encouraged them to take a lot of risk to make shareholder profit return, then if you make them cooperatively owned, they're less pressure to reach the needs of public shareholders. That's the reason, one of the reasons why we weren't in this situation, that Fannie and Freddie were in this crisis, is that we were cooperatively owned, so our pressure points were different. In sum, fix what's broken with the current intermediaries, ensure continued access to low-cost universal credit, push for housing finance to have transparent, open regulatory structure that balances consumer needs, risk mitigation, and broad credit access. I think those should be principles that we should look at. Broad credit access, consumer needs, regulatory transparency, and universal low-cost credit. And I think those have to be preserved if we're to have the kind of fluidity that we've had in our mortgage marketplace since the 1930s, with fixes along the way. Thank you.
Last to speak will be Chris George. You want to stay in place there, Chris? It's fine with us. Okay, great.
Well, thank you for inviting all three of us up here this afternoon. I do not have a PowerPoint presentation to show you. I feel PowerPoint deficient here a little bit. However, I will provide you a little bit of data and some remarks. First of all, a little background on me and our organization. In June of this year, I will have been in the mortgage industry for 30 years. It's almost all I've known in my career. I've had the good fortune to make hundreds of thousands of loans across the United States, and in two separate incidences, I have owned my own company and currently do own my own company. So a little different than my other two esteemed panelists here. I'm the guy that caused this problem, I guess. Is that right? Yeah, seen the enemy and I and he. So. Let me tell you a little bit about what we were doing, first of all, briefly, and then I will comment about a couple of things that Dwight and Larry talked about. So in the good old days, you all know what we used to do, not too long ago, the good old days, on how we used to make loans and who we made loans to. First of all, we pretty much didn't care if you made any money at all. Whatever you told us you made, we believed you. Secondly, we were not too interested equally in the value of your home. We would lend up to 100%. In some cases, we would lend up to more than 100% of the value of your home. So long as your credit report hit a particular number, we didn't really care really what your credit was like all that much. We didn't care how much money you had in the bank. We didn't even care where you worked, what you did, or how you did what you did. So long as you could fog up the proverbial glass, we would make you that loan on the 100-acre goat farm on the geodesic dome outside of Napa, California. In many ways, consumers loved that kind of lending. And for just a second, we have gotten to a place in our policy making where we've started believing that the product is predatory, because products aren't predatory. Theoretically, I can take a 30-year fixed-rate mortgage and I can make that mortgage predatory. I can hurt you with a 30-year fixed-rate mortgage. See, the process of predatory is not a product, it is a behavior. people take products and make them be bad because of the way that they sell those products. And one of the comments that Dwight talked about is this thing called suitability. There was a wonderful lender here in the Bay Area, and for 22 years, made a lot of money for its shareholders and made a lot of really good loans. Matter of fact, the first loan I ever had on my house, and I've been in the mortgage industry for a long time, was this dastardly loan called a pay option arm produced by the folks over at the place called World Savings. The first loan I ever had on my house. Now for me, it was a phenomenal loan. I was a guy that was in business just starting out, and I got to pick which mortgage payment I wanted to make. When months were great, I'd make that payment that was a 15-year amortized mortgage. When months weren't so great, I'd make that payment that was interest only, and either way, I had the flexibility of never having to go delinquent on my mortgage. We killed off a lot of those loans, by the way. We've killed off the pay option arm. We've killed off the interest-only mortgage. We've killed off product that many of you in this room have used, because when I bring up names like pay option arms or pick-a-pay or World Savings, I see a few of you giggle and a couple of you needle your seatmate next to you. So where are we today? I won't ask if you've refinanced or purchased a home in the last couple of years, but if you have, we've moved away from underwriting to investigating you, haven't we? It's nearly forensic on how we go after. It's almost a blood sample, to the point that we check everything, and you roll your eyes, and some of you say, but wait a minute, Chris George, that's not the way it used to be. And those days are long gone. People look at stated income loans and they said, who in the world would ever want to have a stated income loan? Well, they used to only be made to people like me, people that were in business for themselves, who were able to legally deduct certain expenses that would reduce the amount of income that I would have to declare my taxes on. But I could show you that I had a lot of money in the bank, I could show you I had fantastic credit, and I could show you I could put down a big down payment. Well, we went away from those loans and we started giving them to people that had W-2 income, not business for self income, and we stopped letting them put down big down payments. We let them put down 20 or 15 or 10 or 5, and in some cases, nothing, as silly as that sounds. And by the way, if you want to know who's to blame for all this, we all are. We all knew what was going on. We all knew that we were making loans that you kind of looked at me and said, I don't have to supply you anything. No, just sign right here. And again, those of you that have taken out a mortgage in the last few years, there becomes a point when you're signing documents that you're not even looking at what you're signing any longer. You're just signing to get the document signed and get out of that title company and get on with the rest of your life. Where are we today? Everything you tell me I check by way of third party. I can check your income directly with the IRS. I can check the amount of money that you have in the bank directly with your bank without you knowing it. I clearly can check your credit without you altering it in any way. I can check whether or not you've applied anywhere else for any other mortgage if you have an open mortgage application anywhere. And I can check, double check, and triple check how much your house is worth. Today, it's very difficult for you to get something by me, with the exception of a couple of areas if you would like to know. Number one, occupancy. It's hard for us to confirm that you actually are going to move into that property. So we have this thing called a mortgage maintenance plan where we'll go back and knock on your door to see if you're actually living there. And we do that shortly after you go and buy your home. Number two, this thing called undisclosed liabilities. If you have not told me about a mortgage that doesn't report to a credit bureau, it's a private loan between Larry and you, and not the Federal Home Loan Bank, but between two private people. Sorry. Yeah. And if you like what I say today, I should probably give this disclaimer. I didn't up front. If you like what I say today, my name's Chris George. If you don't like what I say today, my name is Angelo Mazzillo. So listen, we're very good at checking you out today. We know what you do, how much you make, whether or not you're going to continue to make it. The loans we're making are really good loans. Some of the best loans that I've made in the 30 years that I've been in this industry. How do I know that? Take a look at the default rate of the loans that are going on over at FHA. It's phenomenal. When you take a look at some of the business that's being done at FHA, Fannie, and Freddie, it's some of the best business we have ever made. Let's talk about getting rid of the GSEs, and I'll give you some statistics. First of all, you guys know there are 3 kinds of lies. There are lies, there are damn lies, and then there's statistics. So let me give you some. In 2009, 10, and 11, by way of market share, each one of those years, respectively. In 2009, we did $1.9 trillion worth of business, equity exchanging hands in the United States. In 2010, about $1.5 trillion. In 2011, about $1.3 trillion. Respectfully, Fannie and Freddie's share each year, 68%, 2009, 80%, 2010, 70%. By way of Fannie and Freddie's own information, you can go to either fanniemae.com or freddiemac.com and you can find all this information. Fannie says, and in that 3-year period between 09 and 11, they made 6.6 million loans. Freddie Mac says in the same period of time, they made 5.4 million loans. So something in the neighborhood of about 12 million loans were made throughout that 3-year period of time by both those agencies. Forget about FHA for just a moment. If you decide that we should get rid of those organizations, and if the whole idea here is to protect us against another disastrous downfall like what we just have gone through, private capital doesn't come in unless private capital can earn more return. It's really that simple. And there's not a one of you in this room that has ever gone to me and said, I'll make you a loan. I can make you a 4% loan today, 30-year fixed, and I can sell that loan to Fannie or Freddie. But if you would really like your loan to go to private capital, I can sell the same loan at 6% to private capital. Which loan would you rather have? In other words, right now, perhaps you're getting these astronomically, historically low interest rates because perhaps Fannie Mae isn't charging you enough. If interest rates were higher, given the kind of quality we're doing right now, perhaps private capital would come in. Just the elimination of the agencies does not automatically ensure private capital shows up at the same price that the agencies are in place. But listen, if we get rid of them, then who would have made these 12 million loans over the last 3 years? And if we had been able to make those loans over the last 3 years, what would have been the interest rate? Right now, my dad bought his house in 1962 in Martinez, California. He was thrilled to get an interest rate at 5%. He has long paid off that house, and today he looks at us and says, you're making loans to people at 4%? I bought a house nearly 50 years ago, and yet you're making a loan to a person that's less than what I bought that loan for. I can assure you that if there were private capital, you would not see that kind of interest rate, number one. Number two, why do we have to do everything all at one time? Because we've done some things already, by the way. First and foremost, we've made a lot of changes on how we make loans and who looks them over. So in other words, there's a lot more regulation today than ever before, particularly on industries like mine. Places and things that have not been resolved yet. Larry talked a few minutes ago about Dodd-Frank. We haven't even finished writing Dodd-Frank. We're arguing over a component of it right now that could theoretically get delayed because we're in this wonderful time called an election year. And this thing called a qualified mortgage that talks about who's liable if the loan is made badly may very well get kicked down the path until after we get done with this election year. So we're not nearly at a place where we've stabilized what even the rules are today. And yet we continue to go on selling loans to Fannie and Freddie and FHA. A couple of comments about Dwight said, why FHA is so high? You guys know the answer to this. Because to do an FHA loan, you only need, on a purchase, you only need to put down 3.5%. And nearly the rest of the Fannie Mae business is generally a 5% down payment and requires mortgage insurance. And as you well know, many of the mortgage insurance companies, one here in the Bay Area, are on the edge of their seat of being viable. The one in the Bay Area was a company called PMI. Been around for a long, long time and is virtually bankrupt right now. Let me conclude with a couple of things because I know you want to ask questions and I see my hook coming my way to the right side of me here. I do agree with a few things that Dwight says, and one of them is this. We need to change the way we're doing mortgages today. And here's what I'm thinking about. First of all, one of the number one problem for a home going into foreclosure, I could ask all of you to write that down, and you're going to write down a series of different answers. Some of you are going to say loss of job, loss of income, loss of equity. You're going to say divorce, death, illness, whatever. There's only one way your home goes into foreclosure. That's because you have a loan on it. It cannot go into foreclosure if it is free and clear. Well, I will add an asterisk. You could file foreclosure if you do not pay the taxes for 5 years. Outside of that, generally speaking, it's hard to lose your home through foreclosure. The United States of America needs to go on a debt diet. The whole concept of leverage was very sexy back then. I'm going to buy one house and buy another and flip it and buy another and flip it. And you know what? I need a backyard, or I need a pool. I need to pay off my charge cards. There's this giant ATM known as my home. I'm just going to keep pulling money out because according to almost every single rating agency, they believe that homes always did what in a small percentage? Go up. That's how we were rating these things. There's an implied 5% increase in homes forever. So listen, we've got to figure out a way to get America out of debt. We've got to figure out a way to let your product work for you in advantage of reducing the debt. There are products out there today that are like that. By the way, there are products like that outside of the United States, and they're very prevalent. Some of them are called an offset mortgage. Some of them are called an all-in-one, in which they combine your checking account and your savings inside your mortgage. So think about it for a moment. If you take the money that's in your checking account and let it pay down your mortgage for a day, a week, a month, or longer, you immediately pay less interest, which means more of your principal, maybe more of your payment goes to principal, which means your mortgage pays off faster. That's where we have to go. Anytime you eliminate choice to the consumer, it's bad for who? Anytime you eliminate choice for the consumer, it's bad for who? The consumer. Some of you need interest-only loans. Some of you will want a pay option arm. Some of you ultimately are going to look at a product that's going to help you pay off your mortgage earlier. That's the kind of thing that we're focusing on nowadays. And lastly, before you shush me and let them go to questions, don't get lost in the ordinariness of this campus. I get to come here every once in a while. I still am blown away by the beauty of the architecture, internally and externally. It is absolutely gorgeous. So don't walk around and see it every day as just another building. It's phenomenal. If you look around and see today in a different light, then you've heard at least one thing I said. Thanks for having me here today.
So time to turn to Q&A and conversation with our panelists. If you would state your question briefly, then I'll repeat it for our videotape, and we'll get an answer from the panelist or panelists that you would like to answer. I see Julia's hand.
Question for Mr. Jaffee. First of all, thanks, everyone. I was wondering, you mentioned the new suitability requirements replacing the old predatory lending, but I'm wondering, since we don't have a guarantee that the Consumer Financial Protection Bureau will expand, how are we going to make sure that the lenders are still following rules and not just, underhandedly or backhandedly saying, well, I'm going to say you're suitable even though clearly you're not? How do we prevent it from just becoming predatory lending under another name?
So the question is, we can easily write suitability standards. How do we actually enforce them?
So we actually have quite a bit of experience with them in the brokerage industry. Your local Merrill Lynch office also operates under a suitability requirement that if you come in and say, I just want to buy blue chip stocks, they'll probably set up your brokerage account without a lot of discussion, although you may note you fill out lots of forms with your income and all kinds of stuff. But if you say, I want to trade lumber futures, they're going to say, well, how many years have you been trading them, and what's your knowledge? And they won't allow you to do it. They will not open up an account. And they've operated under that suitability requirement. It has sort of type 1 and type 2 errors. Chris was referring to like what you might call a type 2 error, that maybe people that really should be trading these kind of exotic instruments are being denied it. Being a finance professor, I sometimes think I can trade these things, and I don't meet their normal requirements, but I've always been able to talk my way through. So I think this type 2 error that people won't be able to be certified when they really have a good reason is unlikely. It's a little friction, but it's not bad. But the primary thing that makes them honest on the suitability requirement is if they allow this person to go trade exotic and they lose all their money, they're going to sue the bank or they sue the broker, and they win. And if you just keep your eye on the paper, every year there's 5 or 10 cases where Merrill Lynch or some other broker has done something really stupid, and they get sued and they lose, and they give back all the money to the person. And the same principles should be applied and will be applied in the mortgage market. If it all works out fine, no one's ever going to question whether it was suitable, because sort of ex post it was. It's when it doesn't work out that someone's going to go back and say, well, how could you have ever done that? It wasn't suitable, and the bank has to pay off. So I think it has a very good monitoring mechanism. The details have to be spelled out perhaps a little better, but I think the principle is pretty well established.
I love when the answer to enforcement is to produce a vigorous plaintiff's bar. I think that's always a good idea. Other questions?
There was mention of wealth accumulation as, of course, one of the things that we've always had for homeownership, but I was wondering if we should still be touting it. I thought we were trying to educate people to come back and let's talk about housing for homestead.
I think that's the debate. My point was...
Let's restate the question simply. If we think about affordability and we think about wealth accumulation and shifting the home ownership rate, what's really at stake?
Well, I think that's the question. I think that's the public policy question. I think the question is laced with lots of socioeconomic dynamics. I mean, particularly for minorities and communities of color, it is the only source of wealth that has happened in those communities. It is the only pass down. When you look at what happened from the 30s through the 60s, it was largely for ethnic families who benefited from the GI Bill. I mean, if you look post 80s on, it's been basically an opportunity for Latino and Black families to accumulate some sorts of wealth that they could pass on to the next generation. And I think that's going to be a challenge that Congress is going to grapple with, and the various caucuses are going to grapple with any kind of reform to Fannie and Freddie.
You know, in the end, with respect to home ownership rates, y'all are going to be the ones that make that decision, right? I mean, we've moved from our home being more of a major concern, being it's a investment and maybe to some measure some tax shelter, some measure, to now I think that's become more of a minor consideration. I think we're moving back to what a home ownership and buying a home should be about, and that's quality of life. Look, at the end of the day, if you assume that no home is ever going to appreciate again and you get rid of all my tax deductibility of my interest and my taxes, well, I can rent a house and let him fix the water heater at 2 a.m. in the morning. You know what I mean? That changes the context a little bit, except when you put quality of life in. I want to paint my house purple, and he's not going to let me do that. I want to landscape my backyard with all grass or no grass. He's not going to let me do some of those things. So home ownership is starting to migrate away from it all about the investment component and about that quality of life component. We're making loans today under this program called HARP, the Home Affordable Refinance Program, in which it doesn't matter if your home is underwater, it can be 130, 50, 200% loan to value, and we're making loans to people who have good credit. What we're finding is something very peculiar that's happening. We're lowering people's payment down to today's rates because they do have good credit. They do have good income. They do have good savings. But what's interesting is that by way of when we close that loan, if you close a loan today, your first house payment on your new house payment is not until June 1. You don't make a May payment. So our consumers are going, hey, well, wait a minute. I don't have to make a May payment and you're lowering my payment by $200 or $300 a month? Yes. When we're asking them what they're doing with that money, the two top answers we're getting, A, I'm going to pay off debt, or B, I'm going to save it. It wasn't that long ago that the United States of America went negative in our savings rate, and we're kind of coming back. So it makes me feel like I don't know. I'm got hope again. You know, we're going back to the way we should be. Maybe our grandparents had it right?
Room for optimism. Dwight, you had something to say?
I think it is a critical question. I would say it's the thinking that a home is a surefire investment is a major thing that got us into the problem. My colleague here at Berkeley, Ken Rosen, used to say we got into thinking that we had 3 earner families, myself, my spouse, and my house. And that led to the subprime boom where everybody, I think, the lenders and the borrowers thought this was it couldn't go down. It can't go down. And then all these loans with no income and every kind of wrinkle make a lot of sense. If it can't go down, you can't lose and maybe you'll win. I think those days are behind us. And by the way, Europe has never had this attitude. If you talk to the average European homeowner and say, do you think you're going to make a lot of money on that? They think, no, it's my shelter. And once you take that attitude, and of course, we've just had a huge overbuilding boom. So if you were a fundamental economist saying, is this an industry you want to be investing in, single-family homes in America? Probably the answer is not quite yet. We just built a lot of them that are unoccupied. So I think that we're in a new world, and we have to recognize that shelter remains important, but multifamily housing is probably where we should be putting more effort than single-family in the immediate future.
Probably 1 or 2 more questions.
Kind of following up on that topic of multifamily, what are your views on the role of Fannie in the multifamily marketplace? Do you have the same views?
No. So
The question relates to Fannie Freddie roles in multifamily.
So no, I'm often asked that, and I never get the footnote in about that. Fannie and Freddie did play a very important role in funding multifamily finance, multifamily apartment construction in the United States. HUD also has similar programs, and whenever I say it to at least an informed audience, they all say, oh, don't make me go to HUD. I loved Fannie and Freddie. The bottom line is I think we need to have a continued government support that at least keeps multifamily housing on a fair playing field in terms of its funding. And if we don't have Fannie and Freddie, we should be doing something that is a substitute for it. And I don't quite know why it can't be the FHA, but in fact, I'm going to the FHA next week. We have a very friend of Berkeley, by the way, is the new acting director, Carol Galante. And one of the things I plan to tell her is what you should really be pushing is more FHA multifamily funding and get rid of this old stigma about it.
So 2 more. First and then Tim.
For those who point towards the Community Reinvestment Act as one of the drivers of the crisis, do you think that argument has any merit, or are they using CRA as a scapegoat?
Thoughts on the Community Reinvestment Act and CRA? Have we seen the end of the scapegoating of CRA, or is that still in play?
No, I don't think we've seen the end of it. And I think it serves political purposes. I think that we're naive to think that these decisions are not going to be made with political consequences, because the redo of the housing finance system will be done through Congress, not just the administration. And I think that there's a politics that's out there that says that credit allocation to certain communities and certain people were the problem. And I think it serves their political needs. I also think that there are those who believe that CRA is regulatorily burdensome, and so you have people who may have some legitimacy in their criticism about the regulatory burden marrying up against people who have an ideological perspective, and then they use the subprime crisis as their answer. So you got a false equation.
I completely agree, and I would add there's actually a lot of academic research that confirms that, and it's an interesting thing what you can do. Most of these requirements are based on the characteristics of the zip code, and so you can look at 2 zip codes that are right next to each other where one of them just fits under, say, the CRE or the CRA or the housing goals, and the next zip code, which is virtually identical, is just over it, and say, do we see any sense of bad lending and bad events in the qualifying? And you see almost nothing. So and if you see anything, it's beneficial. So I agree completely. It's a political agenda that those folks have.
Now 2 more. Tim?
Sure.
And then Paul.
I got a comment and a question. From a commentary, this really a commentary standpoint around Dwight's explanation of forbearance versus forgiveness. You're absolutely wrong in that Fannie Mae is providing forbearance for long term. It's very short, it's finite, and it's only for people who have job loss. It's not for everybody. It's not a program designed to supplement home ownership. It's not a program designed to supplement the crisis that we're currently involved in. Forgiveness is definitely something that they're evaluating now, that they should be evaluating, because although we talk about moral hazard and its implications, I think right now we're well beyond that conversation. Now, one thing that you did indicate was all the things that the government did wrong and that the regulators did wrong. I'd like to get your thoughts on what exactly are they doing right? What have they done right? And what should they build on from their current perspective?
The question is, what commendation can we give to the government in steering us through all of this? Are there credits, or are they only debits here on that record?
So let me take up the latter, and then I'll do the former. So I am a complete fan of HUD and FHA and everything we do for lower-income, first-time home buyers, and I think we should do more and more. Other than that, I think the primary role for the government in any market, but it would be these markets, is where there is a visible market failure, where the market system is simply not performing, and we can identify the problem, and we can make a good case that the government can do it better. And as I say, I think that is true for first-time home buyers and for lower income. I think it's very hard today, given where we are in the world, to see very many other examples where the housing and mortgage markets have market failures. And again, I would say Europe is the example. On the forbearance, maybe I exaggerated in terms of the duration of the program and the qualifications, but I think we probably agree what they are doing is a good thing, and you're simply saying more would be better.
No, I'm not.
Okay.
I'm saying forbearance is a tool, and it's one of the tools in which they're using. I think they need other tools, right?
Okay.
But forbearance is a very small aspect of the tools in which they're using.
And then I wanted to respond a little. A couple of things. One was, I think we can't lose sight of the fact that TARP was originally passed as a bailout for homeowners, and was ultimately used for banks. So the original intent was to create an RTC or homeowner loan corporation type activity that got lost. So choices were made by the government in both parties as to not to do it that way. And so secondly, what we've done is then created a piecemeal approach towards, and boutique programs towards, a huge crisis, as I call it, ignoring the whole closet, right? With just throwing it all in the whole closet. And so we continue to have this incredible drain on the American economy because the government hasn't, in my opinion, been as aggressive in this area. So this is where I disagree with my esteemed panelists here. I think if the government had been more aggressive in this area, had done more in this area, we'd probably be further along in resolving the crisis. If you look at 1989 and the S&L crisis that I alluded to, the government stepped in and was very aggressive, restructuring us restructuring lenders. Yes, a lot of it was commercial property along with single family. Nonetheless, it had never happened before either. And the government solution was to create the RTC. And by 1995, it was a government agency that went out of business. And the economy had grown back, and real estate was allowed to retweak and redo itself. I think that level of aggression has not been had by either administration, and I think we're paying the price for it.
And just one quick point of perspective. There was a period of time in just about August of 2008 where, we were really on an edge. A really bad edge. There was a period of time that everyone will tell you that we were right within weeks of being in a disastrous place, all the way from the run on the bank to just about every aspect economically that you could be. So I just would almost want to, from my perspective, Larry, I just kind of want to get out of the blame, I want to get out of the blame game, and I'd like to get over to the solution kind of fix thing. Now, I know it's Washington, D.C., and it's all about blame there, right? Who you can blame, how you shed or deflect it. But the fact of the matter is that it was really, really, really touch and go there. And as it relates to what I think we got right, I think we got the U.S. Constitution dead on right.
Okay, let me respond.
I'm glad we're finding a way to wind down the debate.
Let me respond to this. It's not about a blame game. It's about where do you want to start the conversation. Now, the problem is I don't want to get there because I don't want to be the lawyer that I haven't been in a long time, but we are a nation of laws and not a nation of men. And if law was passed with a certain intent and then it was done for other things, we got to worry about that. Now, I'm not saying that we weren't at the precipice of an amazing catastrophe, but maybe that required a bailout, and maybe the homeowners required a bailout too. I mean, I'm just sort of saying we needed to deal with the reality of the situation, and we dealt with 50% of the equation. Maybe we didn't deal with the other 50% of the equation, and we've chosen another path, and that's fine. But we need to start with where that is. When you ask, what did the government do right and do wrong? I think that was the major hiccup. I think, in my opinion, what the government has done right is a couple of things. One, I think the whole notion of looking at ways in which we prevent future activities being negatively impacting the consumer is probably a right thing to do. I think looking at this from an international perspective as well as a domestic perspective is the right thing to do. I think that the overreach in looking at risk mitigation is a concern, but I understand you have to sometimes overcorrect too much. And that usually works its way back to a median point. But I think we've got to look at the notion of that we still, not only do we have the negative equity situation, not only do we have states that are still in a housing recession, not only have we not replaced housing as an economic growth engine in this country, we have nothing else that's replaced it, and that we're paying the price for it.
And this debate obviously is ongoing on the campaign trails we speak. Last question, Paul.
So one of the things you all haven't talked about much is not only has the government is playing a huge role in mortgage markets today, 90%, but ironically, the big banks have gotten bigger and now represent 60% of all mortgage loans that are originated. And I wonder what your thoughts are about the implications of that, both in terms of sort of the future of mortgage markets and the future of the need for a secondary market player and what the structure of that secondary marketplace, particularly in terms of access to liquidity for the smaller players that continue to chug along.
So since the grand market adjustment, we've had only increasing shares in the GSE sector and in the big bank sector, whereas a lot of us have been thinking that the solution set is something much more diversified and empowering the middle and small players. What are your thoughts moving forward?
So I would say first, with respect to securitization and secondary market, it's alive and well. First of all, the asset-backed securitization, auto loans and credit card loans, all of that stuff has never had a problem. It continues to function just fine. And in my view, there is no doubt that the private label securitization would come back. Fannie and Freddie may well have made a contribution 20 or 30 years ago in setting some standards. That is old hat. All of that is human capital that we have. We do not need a government entity any longer to say to the world, I've got a quasi-government guarantee, so trust me, and of course the taxpayers will pick it up if I'm wrong. We just don't need that anymore.
I just disagree. I mean, I think that you look at the marketplace and you understand that that part of the counter-cyclical nature of the GSEs is to be there to make sure that there's not credit interruption, and I think they've played that role beautifully. And I think they're playing that role today. That if they didn't exist, we would have had a lot of credit interruption for your ability in a mortgage credit crunch, where you wouldn't have gotten the ability to have a mortgage, whether we do it as a takeout financer for large institutions and small ones, or whether Fannie and Freddie exist. As far as the large banks having a bigger share, I think that's a factor of certain market forces. One, you've had a lot of consolidation of lending, and you continue to have a roll-up of banks into larger institutions, largely to compete globally. Right? If you look at the European model that my friend here is so fond of, they basically have very, very, very large financial institutions that are very, very, very heavily regulated. Right? And that's the source of credit. In America, we chose a different path, which was to allow community lending to occur as well. And market forces are causing some semblance of consolidation to large institutions. Secondly, there are those who will argue there's a regulatory burden that may or may not be necessary, as was discussed here, necessitates that you be a larger institution to make mortgages increasingly. And that could be a change that goes forward, right? That in order to meet the regulatory hurdles, you've got to have so many people in place, and you may not be able to afford the number of personnel that's required and the systems that are required. And so therefore it lends itself towards large institutions. And then lastly, I think what you've seen is a decline of the independent mortgage banker. And so large institutions have fulfilled that void in the mortgage marketplace. I think there are some market forces at play that make the large institutions likely to. And then what we're able to do is as the Home Loan Bank of San Francisco and the home loan banks is basically allow those mortgages to be pledged to us and give them cash in return, which encourages their participation in the marketplace as depository institutions.
Are there any surviving independent mortgage bankers who want the next to last word before Dwight speaks?
I need to respond. I didn't previously.
Yield my time to the Senator of Nebraska.
There is no evidence that Fannie or Freddie have ever been contracyclical in their behavior. You can go through every episode where there was a problem and they always were on the wrong side of it. And most recently, they doubled their market share in 2007 to buy subprime mortgages. They came in and piled on. I wouldn't say they caused the crisis. They made it extremely bad. And secondly, one has to understand that 80% of what Fannie and Freddie are doing today is refinancing mortgages that they already hold. They're not out there. They are the smallest participant in home purchase mortgages in the entire country. They are not active helpers in this. I'm not saying the Federal Home Loan Bank for it.
Here's the difference is Fannie and Freddie are where the market is today. The market today is in refinancings. There are not as many originations being made. Okay, and so that would not be occurring at the level they are if they didn't exist. At the price point, we've got to look at the price point. Do we really want, that's why I come back to the fundamental question, do we really want universal low-cost credit available around the country at a lower price point? I'm not saying it couldn't happen in other ways, but that's what you've got to be concerned with, is the price to the consumer.
Chris, final thought?
I think you two guys should go on a cruise together. All right, so here's my two comments real fast, because I know we're over time. One, yeah, the big banks got bigger, right? Everybody kind of rolled somebody else up. B of A rolled up Countrywide, Chase rolled up Washington Mutual, Wells rolled up Wachovia, blah, blah, blah. It frightens me that they're getting a little bit bigger because I think what you just said a few moments ago and what I said earlier, that the moment you remove choice, the consumer is the person that's going to suffer. And as an independent mortgage banker, yeah, it's a little concerning to me that you can only play in the mortgage market if you're a big giant bank. Well, there's a lot of communities, particularly the first-time homebuyer community and many minority communities that are not served all that well by large institutions. They're little guys like me that go out there and make a niche in particular products. So the last thing I'm going to say is I'm hopeful. I truly am. I know there's a lot of despair and bad news out there, and my goodness, it is just the front page of every magazine seems to be about what's wrong and what's not working and who's not doing what they're supposed to be doing or who did something they shouldn't have done. I really think we're going to get this right. I really think we're going to get it right the first time, because there's a lot of people talking about not doing it wrong and then going back and fixing it again. So I'm hopeful that we're going to get it right. Whether the GSEs live or die, whether they become public, stay public, or remain private, irrespective of all that, I think that the next wave of home ownership in the United States is going to have some huge improvements that the last wave didn't have, and I think that's better and good for all of us.
Well, on that note, thank you very much, panel. And thank you, audience. That concludes our program today. Thanks so much for coming.